Hello and welcome back to this channel. How to trade with a stochastic indicator. A stochastic indicator measures the momentum and trend strength in the market. It shows you the price momentum a few seconds before it reverses. So you have an excellent opportunity to enter and exit the market and make profit. In this video, I'm going to show you how you trade efficiently and professionally with this indicator, along with some practical example to clarify the trading strategy. So please stay tuned till the end of this video. What is a stochastic indicator? A stochastic indicator was developed in the late 1950s by George Lane. It presents the location of the closing price of the stock in relation to the high and the low range of the price over 14 days period. It measures the momentum and the trend strength in the market. Momentum is like a piece of rock that you throw it in the air. At the beginning, the speeds are very high, and as the piece of rock goes in the sky, the speed reduces. The same as momentum. Momentum, the price momentum at the beginning is very high and wanted to go higher and higher. And as the price go up and the time pass by, you see the momentum of the price reduces. And it reduces until it comes to a stop. And then it reverses. And the price reverses just a moment after. The price reverses and going down. Momentum always change direction before the price. A stochastic shows in percentage between 0 and 100 and has two zones, namely oversold zone between 0 and 20% and overbought zone between 80 and 100. In this slide, I'm going to show you how you calculate the stochastic value in uptrend over 10 candles. Let's assume we have 10 candles in line. These are the 10 candles and it is in uptrend direction. Now let's assume the highest high value of these 10 candles is $83 and the lowest low value of these 10 candles be $30 and the last close price of these 10 candles is $75. Now the highest high minus the lowest low is $53 and also the last close price minus the lowest low is $45. So it is very easy how you calculate the stochastic. The stochastic is nothing but 45 over 53 multiplied by 100. So it is, the number you get is 84.9. And since this number is between 80 and 100, for sure this number is in overbought zone. You can see the high value of stochastic shows us that prices are very strong over the 10 candles. And the recent candles are even pushing to go higher. I'm also going to show you how you calculate the stochastic value in downtrend over 10 candles. Let's assume you have 10 candles in line, which is going to go downward. So these are the 10 candles and it going downward. Let's assume the highest high value of these 10 candles be $105 and the lowest low value of these 10 candles be $30 and the last close price be $44. Now if we deduct the highest high minus lowest low, you get 75, and if you deduct the last close price minus lowest low, you get $14. And the stochastic value is nothing but 14 over 75 multiplied by 100 is equal to 18.66. Since it is between 0 and 20%, it is in oversold zone. You can see the low value of stochastic shows us that price close only 18.66% above the low of the range, and consequently the downtrend momentum is very strong. This is the price trend and K-stock D1 time frame, I installed a stochastic indicator with 14 days period. These are overbought zone indicated with the blue color, rectangle blue color, and these are oversold area indicated with rectangle red color. And these are the two zone, 20% and 80%. Now, a stochastic indicator has two curves. One of them is fast moving average indicated with red color here, and the other one is a slow moving average indicated with blue color. If the red color be above the blue color, it shows an uptrend, and if the red color be below the blue color, it shows a downtrend. Some traders follow this technique to enter and exit the trend. In overbought zone, if the red line crosses the blue line and cutting the 80% line while going downward, it generates a sell signal. In oversold zone, if the red color crosses the blue curve and cutting the 20% line while going upward, it generates a buy signal. Please do not mistake this as trading strategy, because it is not. Rather, it is an entry trigger to get you into the trade. Oversold area is an area where uptrend momentum is high and is willing to go even higher. Unfortunately, some traders go short when the price, as soon as the price enter the overbought zone, and the price stay in overbought zone for a long time and even in going higher, so they lose lots of money. There are sometimes that the trend reversing and you have to go short, and I will talk about it later in my next few slides. Oversold area is an area where downtrend momentum is high and is willing to go even lower. Unfortunately, some traders go long when price, as soon as the price enter the oversold area, and the price stay in oversold area for a long time, maybe weeks and months, and go even lower, so they lose money. There are times the trend is reversing and you have to go long, and I will talk about it in my few next slide. Stochastic is telling you where the momentum is reversing before the price reverses. This is a good tool to predict the future. I am going to show you how you trade with a stochastic indicator like professional. This is the price trend, K stock and D1 time frame. I installed a stochastic indicator with 14 days period, and also I installed simple moving average with 100 days period. These are the overbought area and these are the oversold area, and with 20 and 80 zone in a stochastic zone. Now, in order to trade, the first thing you have to do, check the direction of the trend in a longer time frame, e.g., for example, D1 time frame. So you go to D1 time frame and you want to trade with the trend, not against the trend. As you see in D1 time frame, which is this one, the trend is going downward. Then you only can exit the trade. So please ignore the oversold area, because the oversold area is for entering the trade only. In order to exit the trade, go to one time frame lower. One time frame lower is H1 time frame, and use your price action such as pattern and formations and also candlestick mat blending, and you might want to go short after a bearish reversal pattern at the resistance area. These are the places that you can exit the market. This is the professional way. In this slide, I'm going to show you how you trade with the stochastic indicator like professional. This is the price trend, K stock and D1 time frame. I installed a stochastic indicator with 14 days period, and also I installed simple moving average with 100 days periods. Remember, you can use 100, you can use 150, you can use 200. It's your preference. Now, these are the overbought area and these are the oversold area. And there is a two zone, a stochastic zone, 20 and 80% zone. Now, in order to trade, first check the direction of the trend in the longer time frame. For example, D1, because you want to trade with the trend, not against the trend. As you see, the trend is going upward in D1 time frame. Then you can only enter the trade, not exit the trade. So ignore the overbought zone area, because the overbought area is only for exiting the trade. In order to enter the market, you go one time frame lower, H1. So you go to H1 time frame and use your price action, such as pattern and formation, and also candlestick matte blending, and you see a sign of uptrend, you sign of reversal, and you might want to go long after a bullish reversal pattern at the support. This is the professional way to enter the market. In this graph, I'm going to show you the mistakes some traders make while using this indicator. Now, this is Kinder Morgan stock H1 time frame, lower time frame. Now, this is a stochastic with 14 days period. These are overbought and oversold area. Now, here the trader already bought a share and he's in the market, and he saw that this trend is going downward. So he said that I better exit the market here because I'm going to lose lots of money. So what happened is he exit the market. What happened is he exit the market right there. He exit the market in overbought zone. He exit the market. So he never checked the bigger picture. Now let's see what is the bigger picture is. This is the same graph, but let's see Kinder Morgan, but in D1 time frame. These are the same stochastic, and I installed simple moving average with 100 days period, and also these are overbought and oversold area. Now, this gentleman, that he exit the market here because of these 6-7 candles, all these 6-7 candles is worth only one candle here. Only one candle. For one candle, he exit the market. But he never see that how much he lose money because the market is going upward. And he's continuing again for maybe another month upward. So all the time, before you enter or exit the market, first check the bigger picture, the longer time frame, and see whether the trend is upward or downward. If the trend is going up, means the price is above the SMA 100, you ignore the overbought area. If the price is going down, it means the price is below the SMA 100, going down. Then you ignore the oversold area. So this is the professional way to use this indicator and you make profit. How does a stochastic indicator perform in range bound? This is the price trend, WCP D1 time frame. I installed a stochastic indicator with 14 days period. Now these are the overbought and oversold area. A stochastic indicator perform excellent because anytime the trend reaches overbought zone, it reverses when it loses its momentum, and anytime the trend reaches oversold area, it reverses again when it loses its downtrend momentum. And this way we realize that the stochastic indicator shows the top and the bottom of the range with a very good accuracy. Now if you erase the stochastic indicator and you draw your support and resistance level, you see the same result. Now I'm asking you, do you need a stochastic indicator in range bound? I think you don't need it, because the support and resistance does the same job without installing any stochastic indicators and going through those headaches. To recap this video, first, use simple moving average SMA 100 to check the direction of the trend in longer time frame, D1. Second, use a stochastic indicator to identify the overbought and oversold area of value of the trend in D1 time frame. And finally, third, use candlestick pattern, candlestick matte blending, or stochastic to serve as entry trigger in shorter time frame, H1. That's all, folks. If you like this video, thumbs up and subscribe. Thanks for watching. Take care and see you next time.